Hey there, Mark Yegi from the Cashflow Machine, and I'm doing a quick video here on selling covered calls and why I think selling covered calls is a really conservative strategy for creating safe, reliable income in the stock market. You get the income every week, and I want to show you how I do that. So stay tuned. Here we go. We're just doing an introductory video about how to sell covered calls so that you can generate reliable income. That's really what we're all about. So I want to start off with some cornerstones of whatever you do. Like whatever you do in covered calls, you need to have these four cornerstones. This is the way to do it. You got to find the right stock, right? That's the main thing. You got to, first of all, pick the right vehicle. Then you've got to be in the right market. You can't just be in any market. The market has to be kind of the tailwind for you. You've got to find the right spot on the chart because there's certain spots on the chart that give you the highest probability of success. And then you got to do what's called squeezing the juice. Most people call collecting the time premium. That's really what we're all about. We call it squeezing the juice in our program. So let me give you a quick introduction to selling covered calls. What is a covered call? Let's start with that. Well, it's an option strategy where an investor would buy a stock and sell a call option against it and create that income that comes in from when you sell something. You sell it to the gambler on the other side who is going to buy your call option from you. And maybe you already own a stock. So I have some customers that own stock like Tesla, for example. They have some Tesla, 1,000 shares of Tesla, and every week they write calls against it. They give somebody else the option to buy their Tesla at a certain price by a certain date, but they always roll their option to the next week so that they never get taken out of it. And so what happens is they sell the call. They might get like $5 for the week. Well, that's $5,000 a week they would get on just owning the Tesla. So that's what a covered call is. Why would you sell a covered call? Well, it's basically to provide income, and it also provides a little bit of downside protection because you lower your cost basis when you buy a stock, and then you get some money back immediately for selling the call against it. So you lower your stock basis, lower your risk. Now, when you lower your basis, if you buy a stock at 100, you sell a call, you get a couple bucks for it. Now your basis is 98. The stock has to go down 2% for you to start even losing money. Nice little strategy, right? So some things that you need to consider when you're selling covered calls is you've got to be aware of the assignment risk. Now, this rarely happens in non-dividend stocks, but if the stock rises above the strike price, the person you sold the option to can say, you know what, I think I want that underlying stock. And then you have to sell it to them because that's what you agreed to. So that's the real risk. The other one is that you may miss out on some of the upside if the stock keeps going up, but that's not why we're in this, really. Covered calls can be a useful option strategy, but you've got to know that they have some trade-offs, right? There's no free lunch, right? So you have to know that. So what are some of the benefits of selling covered calls? Well, we talked about it. First of all, generate income. You lower your cost basis, right? You get a little bit of downside protection because if you keep doing this over and over, you keep lowering your cost basis, putting money into your account, and then that gives you that cushion that you want. You can profit from the time decay. So when you sell a call, right, an option to buy your stock, you sell it to somebody else. As it approaches expiration, the time value of it declines, right? 1 second before it expires, it's worth practically nothing. But 2 weeks before it expires, there is some value given to the person that bought it. There is a time decay component that you get. So 80% of all options expire worthless if you're the buyer. Bottom line is 100% of the time, you get the option premium. Always. So if that's what you're after, you know that 100% of the time you're going to get that option premium. And if you have a good stock, that's a nice chunk of change that you get to bring in as income. You also know that you can sell at a predetermined price. Like you know what your exit strategy is going to be. So by knowing that exit strategy, you know exactly how much, if the stock goes above your strike price, how much you're going to make by selling covered calls. Really cool. And then you can hedge against market decline. So if the markets are going down, obviously, just like when the stock goes down, you have some downside protection. So what are some of the risks of selling covered calls? Well, downside protection is limited. Like if a stock tanks or opens down, 5-10%, like some of them do at earnings, you're in trouble, right? You've got to catch up. Now, if you're just focusing on the juice, focusing on that income, you're not in so much trouble because you're saying, look, I'm just, getting this income every week. It's like if you buy a house, let's say you spend $300,000 on a house and your goal is to make $3,000 a month in income. You don't care if the house goes to 310,000 or 340,000 or 250,000. Your focus is on the $3,000 a month that you're getting in income. Same thing with selling covered calls. Your focus is on collecting that reliable income that you're getting every month. That's what you want to make sure is you keep that tenant. And so you're going to sell covered calls against your stock. You will miss out on those upside moves. So if you buy a stock at 100 and the stock happens to go in the next month, let's say you have a monthly option and it goes up to 150, well, you're going to miss out on the 50, but you might have gotten $2 or $3 in income. That's what you give up to get that income. How many stocks go from 100 to $150 in a month? Very few. So the risk is pretty good. I mean, it's more likely that it might go from 100 to 105, and instead of getting only 102 for it, you end up getting, or 105 for it, you end up getting 102. Hope that makes sense. You're also forced to sell your stock at a strike price if you let it expire, because if it's in the money, if it's above the strike price, they're going to take it away from you. But we roll our calls is what we do in our program. Most of the time that works. And the dividend sometimes can be assigned early. So that means you might be taken out of your stock short that stock. And so you have to pay the dividends. Okay, you just roll it to the next week and it's not that big a deal. But people are afraid of it because it's a lot of extra work. So how do we sell covered calls? What is the secret? Well, first of all, you've got to select the right stock, right? And the key to selecting the right stock is you want to choose a stock that you want to own long-term, right? You want a stock with limited downside risk. You want a stock with lots of liquidity. You want a stock that's institutionally supported. These are important things. You want a stock with good fundamentals or good technicals. All these are really important in selecting the right stock. But really, it's up here. It's about mindset. 90% of this whole operation, almost every investment strategy, is mindset. So get that on your side. Then the next thing you do is you set the strike price. What is the strike price based on the juice, on the income that I'm going to get on that stock? And that's the one you sell at that you're comfortable, right? And you do that. We do that every week or every month on a regular basis. We're constantly looking at the proper strike price. Not constantly. We do it once a week or once a month. You've got to pick an expiration date. How far are you going out? You can go out weekly. You can go out 30 days. You can go out 60 days. There's lots of different ways that you can go out. The next thing you want to do is you'll place your covered call order. You go in, you buy the stock, you sell the call. It's a very easy transaction to do. I've got videos on my channel here on how to do that. And so that's a pretty simple thing to do when you're selling covered calls. You just buy the stock and you sell the covered call against it. Simple, right? And then you manage the position. If the market's moving up, you got to do something different than if the market's moving down. There are some things that you can tweak along the way to improve your position. And so that's important, but it's not as important as some of the other steps that we just talked about. So what are some candidate stocks? Well, looking at some stocks in 2021, Johnson & Johnson made 10.2%. Procter & Gamble made 12%. Now, these are what are called blue chip stocks. They're really boring. You don't make a huge amount of money, but they don't fluctuate a lot usually, and they bring you in some safe, reliable income, right? So those are some ideas. Here are some example scenarios. So here's how they play out. When the underlying stock price stays below the strike price, the investor keeps the premium as a profit without having the shares called away. So if you can sell calls out of the money and you can just collect that income every week and it doesn't go above your strike price, you just can do it over and over and over again. If it does go above your strike price, no problem. You buy it back and then you sell it for another longer period of time. And you can do it over and over and over again, right? And so that's the deal. You give up that price appreciation, but that's the trade-off that you get for income, right? Income is different than capital gains. All right, so what are some popular strategies? Well, like I mentioned earlier, that couple that owns the Tesla that I told you about, you can sell covered calls on stocks that you want to own or that you already own, right? The next thing you want to look at is sometimes looking at the right high implied volatility rank, right? So high implied volatility means it moves around more. If it moves around more, it creates more juice, more time premium. If it creates more time premium when you're selling covered calls, you get more income, okay? I don't recommend you chase juice, but it is a component of what we do is looking at that IV or implied volatility. Then you want to sell calls at your target strike price. Selling them at your target strike price means everything is in alignment and you've got a strategy and you're executing your strategy, because it's really important to keep your strategy and your mindset right. What are some tools and platforms? Well, there are lots of them. I like TD Ameritrade, Schwab, E-Trade, and a few other ones out there. There's lots of good trading platforms out there. Just make sure that you like that they have a good options platform. I haven't heard a lot of good things about Fidelity, so I don't steer people to that, but maybe they've improved. If this is a game that you want to play, and I suggest that you do, because it's one of those secret strategies that Wall Street knows that you don't, or you may not know it in depth, there are some advanced strategies to learn it. So here's just a couple of them. First thing you want to do is you need to understand some Greeks, right? There's things called delta and theta and gamma. You don't need to know them all. You don't need to know them really in depth, but you should kind of know what they are. right? Understand the Greeks in options, and that's part of the language. You want to utilize the volatility to determine the best stock price and the best strike price for your stock price. So then you want to roll your contracts to maximize time value and minimize that risk. You want to analyze the technical indicators because they're important, but you also have to know good fundamentals about your stock. You have to develop a risk management plan. Risk management is so important. It's really important not to lose money in investing if you can help it. We have some strategies on how to do that. And then tax implications are an important part of doing any kind of investing, especially in covered calls as well. This is a chart that you'll often see in covered call writing when you sell covered calls. There's a break-even point on it. It looks a little complicated, but the bottom line is you can see with that top little line after the 45-degree angle up, you don't make any more money if the stock keeps going higher, right? You only make the amount of money that's around that dotted line there, the strike price. And then after that, you don't make money if the stock goes higher than that. Selling covered calls is really a great strategy to generate additional income from the stocks that you already own or stocks that you want to own. By selling call options and collecting the premiums, you boost your portfolio returns, right? And this is something that Warren Buffett does. The big institutions do it because what they're doing is they're taking advantage of the gambler. The gambler, the one that buys the option and hopes he makes a ton of money on it because he's got very little invested. But that gambler pays the seller. And the seller is like the house in the casino, right? The house knows that they have some odds in their favor, and they're the conservative side of the table. The gambler's on the risky side of the table, and the house just conservatively over time collects that income. So I hope that helped you get an understanding of why I think selling covered calls is a fantastic strategy for creating income. See you on the next one. Hi, Mark Yagi here, wealth architect and author of this book on my covered call investing system called the Cashflow Machine. Listen, what you just saw is just one part of creating reliable income of 2 to 4% a month from the stock market. But you know, if it were that easy, then everyone would do it, right? If you want to learn how I create investment income the right way, then you need to learn and have a system with rules and what-if strategies so that you can learn what I do when the market goes against me, what I do when the stock goes against me, how to adjust my trade so that it's always in a winning position, how much to risk, how to build a multi-million-dollar portfolio that creates income of $10,000, $20,000, or $30,000 a month in semi-passive income. And best of all, the whole Cashflow Machine system takes less than an hour a week to implement. Just go to cashflowmachine.io to learn more, or click this link for more videos, masterclasses, and free resources. See you there. The information you just heard is for education and information. This is not financial advice.